Hello, everyone, and welcome to NCST's monthly community impact briefing. We are going to get started in just a few minutes. We still have quite a few folks joining, so we'll get started here right after the bottom of the hour. It looks like we still have some folks joining, so I'm going to give it another minute or so. It looks like attendees are starting to slowly drift off, so we're going to go ahead and get started. Welcome, everyone. My name is Daren Blomquist, and on behalf of myself and my colleagues at the National Community Stabilization Trust, we're excited to have you with us today for what is promised to be a fantastic discussion about the outlook for foreclosures going forward. As a reminder, we have the questions available. So we will, once we get started here, everyone is muted. You are able to ask questions either through the chat or through the Q&A, and we will have time for that throughout our call. The other thing is we will have a short policy update at the end of our call, and look forward to providing you the up-to-date information on what's going on in Washington. With that, I'm going to turn things over to my colleague, David Sanchez, who is going to introduce our speaker for the day. David?
Hi, everyone. Thank you for joining us today. I have the pleasure today of introducing our guest, Daren Blomquist. Daren is the Vice President of Market Economics at Auction.com, where he focuses on analyzing and forecasting complex micro and macroeconomic data trends within the real estate market. Previously, before Auction.com, he was a Senior Vice President at Atom Data Solutions and at Realty Track. I think many of us know Daren as one of kind of the preeminent analysts and voices within the distressed properties market space. That's why we're so excited to have him here, and why we're so excited to be able to call him a friend of NCST. So with that in mind, I'm just going to pass it over to you, Daren.
Thank you so much, David. It's great to be here, and I'm honored to be known as a friend of the NCST and all of you. So it's great to be here and share some of what I'm seeing in the market. I do get to look at a lot of data, public record data, market data, as well as our own proprietary data here at Auction.com. And for those of you on the call who aren't familiar, before I jump in, and I'm going to share my screen here, Auction.com is, and I know just looking through some of the attendees, I know at least some of you, and some of you are familiar with Auction.com. But we are the leading source or marketplace for distressed properties, and we specifically auction off foreclosure properties, as well as bank-owned or REO properties, which I'm sure all of you are very interested in. And so I'm just going to go through today what we're seeing in our data, as well as other data. I'm going to start with a broad view of the market, just to kind of set the stage for what we're seeing in the distressed market, and then we're going to narrow the focus down into specifically what we're seeing on our marketplace, which we believe is a very good proxy for the entire distress market. We estimate that we account for about 50% of all foreclosure sales nationwide at the foreclosure auction. And that's kind of the leading indicator of the trends that we're seeing in the marketplace. And then we'll also discuss what we're seeing on the REO side, which is a little bit different right now. And we'll talk about that more. But yeah, without further ado, I mean, I would love, as you guys, all of you on the call, think about this, to submit questions, and definitely love to address any questions that you have as we go through this. I mean, I'll probably wait until the end unless I see something that catches my eye as I'm going through this. But let me jump in, and we'll start with the broader market, the jobs market, which is a huge impact for the distress market. Historically, unemployment has, and when we look at the correlations, unemployment is highly correlated with foreclosures, and things have looked a little bit differently during this latest crisis, but this is still something important to look at for what is happening and is going to happen in the distress market. So in September, with the latest jobs report, was very good, and we're continuing to see a lot of improvement on the jobs front. Over 500,000 jobs added in September. We're still 4.2 million below the pre-pandemic level, that benchmark in February 2020. And there's a lot of folks out there who think that we may not ever get some of those jobs back. Eventually, of course, I think it's safe to say that we'll end up below that February, or above that February 2020 level, but maybe some of those jobs that have been lost have been lost forever, just because of the huge shift that we've seen resulting from the pandemic in society and the way we work and all of that. But generally speaking, it's very rosy. I would say in terms of the jobs report, unemployment's down to 4.6%, which is really getting back to close to the natural level of employment, at least if you look at the long-term average. Now, we're still above the 3.5% in February 2020, so still above that. And part of the reason for that big drop in the unemployment rate is that labor force participation. The number of people who are participating and trying to find a job and participating in the labor force has really shifted, and that may be a shift that's more permanent. It's yet to be known whether there's just some folks who've decided that the rat race is not for them. And so we're seeing that stuck at 61.6% below the 63.3%. That doesn't sound like a lot, but it represents several million folks who are no longer really participating in the labor force. And there's a host of different theories around that. But the main thing that we focus on, at least for what's going to be happening in the distress market, is the longer term unemployed. And one aspect of this too that is not included in this chart is really how many of these folks are homeowners, and that's an important piece. I think the working theory, and there's data to support this, is that many of the folks who became unemployed during this recession were not homeowners, and that's good news for the distress market, and part of the reason maybe we haven't seen the surge in foreclosures that might have been feared early on in the pandemic. But we still do have over 1 million more long-term unemployed, and that makes up the bulk of the increase in unemployed compared to pre-pandemic levels as those long-term unemployed. And those, to the extent that those folks are homeowners, that is going to be what impacts the distress market more in the long term. And certainly as forbearance, as people exit forbearance, if they continue to be unemployed, that's going to make a big difference. And then one of the things that we have, and so just to orient yourself with these charts here, that the green line there on the left is the long-term unemployed, and that has come down quite a bit, but we're still well above 1.2 million above the pre-pandemic levels. And then on the right-hand side, we have this, because of this labor force participation rate situation to a certain extent, and some of the shifts that we've seen, we actually have ended up with a labor shortage. There's now 2.7 million more job openings than there are unemployed. And there's a record number of people quitting their jobs. So we have these interesting trends going on that are coming out of this pandemic that, that labor shortage is more of a sidebar, but I think it's a very interesting in terms of the distressed market, but it's been a very interesting phenomenon that we see going on there. And, but certainly the focus here is on those 1.2 million who continue to be unemployed, and the percentage of those that are homeowners will impact potentially the distressed market going forward. And so moving on and focusing in a little bit more on the housing market, really, I see a lot of signs of the housing market moving toward equilibrium. It's been a crazy housing market. It still is a crazy housing market. And probably that word is overused, crazy, but I think it's safe to say when we're seeing 24% home price appreciation in May of this year, according to the National Association of Realtors, that's crazy. That qualifies as crazy, and certainly not sustainable, certainly not good for many folks who want to become homeowners in this market, although certainly good for current homeowners in terms of equity. But we are seeing that start to cool slightly. If you look at that black, I think it is, or dark blue line, that's the home price appreciation. That is coming down. It's still at 13% in September, but we're starting to cool off slowly, and we're starting to see just a very gradual rise in inventory of homes for sale. And so I think the market is starting to move toward equilibrium slowly, in terms of an equilibrium in my mind is more like what you're seeing back in 2019 and early 2020, which is hovering around 5% home price appreciation. And now month supply of inventory back then was still below what traditionally has been considered equilibrium for the housing market, which is 6 months. But we're actually in the new homes market there. New home inventory, which is the blue, the darker blue bar on the top, has officially hit equilibrium in terms of, at least as it's traditionally been defined, of six months of supply of inventory. And so we're starting to see that happening, and existing home inventory is still at 2.4 months, which is very low. But I think that the best case scenario for the housing market is that we'll continue to see this trend of more supply coming to the market and slowing home price appreciation as the market gets back to normal. And there are folks out there who are predicting that home prices will continue on a torrid pace, and we'll continue to see double-digit appreciation into next year. And if that scenario plays out, I think the housing market is in for a rougher ride in the long term, as that to me would be more of a bubble scenario, housing bubble scenario playing out. All right, and then just to look, I found this very interesting in terms of the cool down. We're seeing that cool down in some of the leading markets that have been the hottest markets in the country. We're starting to see a more extreme cooling there. And this is data from Redfin via a Bloomberg article, but basically some of the top counties where we're seeing the percentage of listings with price cuts, and that starts with Boise, Idaho. Probably at different times during this market of the last 18 months, we've seen Boise as the hottest market in the country. And so we're starting to see price cuts there. We're starting to see retail bidding wars start to fall off. I mean, you can see there on the right-hand side, the bars represent, this is according to Redfin, the percentage of listings that receive bidding wars. And that number spiked during the pandemic up to over 50% and as high as over 70% of listings were getting multiple bidders coming in. And now we're seeing that slip a little bit. Actually, I included the data from auction.com here as well, just to give you a perspective. We're continuing to see the vast majority of our properties, and because of the nature of our environment, it's more our auction environment. Of course, it's set up to see multiple bidders and folks bidding against each other, and we're continuing to see that very high. But actually, against the retail trend, we saw that increase in September up to over 90% of the listings that we have, and part of that has to do with fewer and fewer listings, or I shouldn't say listings, but properties available for auction on auction.com. And we'll talk about that more in just a little bit. This is, and all of this is leading up to the affordability and equity conversation, which I think are two sides of the same coin. And if you look at affordability, basically any way you look at affordability, it's getting worse. And that makes sense because of when you see 9 or 10 months worth of double-digit rises in home prices, that is going to worsen affordability, even if you have very low interest rates or mortgage rates, which we have. And this analysis by the Federal Reserve Bank of Atlanta is showing that affordability it's at its worst place nationwide since November 2008. So we're getting back. It's not as bad as it was if you look on the left-hand side. 2006, that affordability metric was much higher, meaning people needed to spend much more of their income to buy a home. But it is trending back up. And if you look at on the heat map there, the areas with the worst affordability, those are the areas that you would probably suspect: coastal California, parts of the West, as well as South Florida, coastal Florida, and then pockets of the Northeast, specifically New York, or at least New York City, and Massachusetts there. So we're certainly, affordability is definitely becoming an issue, if it hadn't been already, in this housing market. And I think one that the distress market actually offers some hope for. And we'll talk about that too in a second as well. But this is certainly an issue. Now, on the other side of the coin, the equity that's being created by this run up in home prices means that real estate net worth is at an all-time high of almost 24 trillion, according to the Federal Reserve. And that's as of the second quarter of 2021. And so this is just crazy when you look at that chart on the left, the spike, that total V-shaped situation. And that's really coming out of the last recession that we see this long. This really doesn't, the pandemic didn't interrupt this trend hardly at all. And we've had more than 10 years of really a very healthy, booming housing market. And maybe healthy is the wrong word, but a booming housing market that has produced a massive real estate wealth for many people, certainly not everybody. And then when you look at that more specifically as it pertains to the distress market, on the right-hand side, data from Black Knight showing that what they call tappable equity, which is any equity that's below 80% LTV. So basically meaning at least 20% equity, baking in that 20% equity cushion, and then anything above that is tappable equity that a homeowner could use for refi, for cash out, but also, more importantly, for our discussion, could use to help them avoid foreclosure, and whether that be needing to sell the property to avoid foreclosure, or possibly refinancing to leverage that equity. And certainly more a homeowner who has a lot of tappable equity, at least in theory, would be more invested in holding onto their home and motivated to keep their home if possible, or at least realize the benefit of that equity from their home. So that sets the stage then to start talking a little bit more about the distressed market. And so I'm going to look at the distressed market through a couple of lenses, through the forbearance lens, and then as well through the seriously delinquent lens. So through the forbearance lens here, what we have is, the biggest pool is 7.7 million forbearances that have occurred now. Actually, well over half of those have exited forbearance already, and there's really about 1.2 million, 1 million that are still in forbearance, and that number is continuing to drop, so it's probably a little bit old. But when this snapshot was taken, there were still 1.2 million in forbearance. Another 200,000 have exited. Another 1 million still in forbearance when I created these slides. And so the forbearance program paints also a pretty good picture that most of the folks who went into forbearance, for whatever reason, that signals some concern that they might be in trouble as a result of the pandemic. The vast majority of those have exited and are performing, and or even paid off the loan. The piece of the pie that we're most concerned with is the red and orange pieces of the pie, which represent about 273,000, and those are the forbearances that have exited and are specifically the red portion of the pie is have exited and are still delinquent. There's no loss mitigation program in place, and so those are at very high risk for foreclosure. And then you have a very small slice there, which I think is blue, 37,000 that have exited forbearance and are actually in foreclosure. And so those two categories combined are the 273,000, and those are at the highest risk for foreclosure. And that piece of the pie is growing. It's up by 56,000 since July, when we saw the national foreclosure moratorium expire at the end of July on government-backed mortgages. And so we're seeing that number increase, that high risk number. And then in addition to that, you have to look at the 1.2 million who are still left in forbearance, at least at the time this snapshot was taken. And if we assume that we see about 3 to 4% of those go into that high risk bucket, we'd have another 50,000 on top of that 273,000, which would take us to about 325,000. And so I think that's a number to hold on to, is if you look through the forbearance lens, there's 325,000 high risk loans kind of coming out of forbearance, which big picture, that I think speaks to the success of the forbearance program. Out of 7.7 million loans that were at some level of risk, we're seeing only 325,000 that are coming out still at pretty high risk, but it's still 325,000. And so and the thing we don't really know and have a good precedent for on this is how many of those are going to roll into foreclosure. And, if we assume just 50%, which is a little bit of sticking my finger in the wind there, but I think, these are high risk, and if they haven't qualified for any of the loss mitigation that's been made available as the exit forbearance, I would assume a pretty high rate of going to foreclosure. That would end up with about 162,000 ending up at foreclosure. And then you do see on the right-hand side, the kind of long tail. We've actually just gotten through the big wave of forbearance exits here in September and October of 2021. there's still a long tail of those 1 million folks who are still left in forbearance that are coming through most of 2022. All right, then through the delinquency lens, which a seriously delinquent lens, which in my view is a little bit more of a holistic way of looking at this. At the end of the day, it's, the folks who are seriously delinquent are as a leading indicator of what's going to be coming down the foreclosure pike. And so we have that number on the left-hand side. That's the red and the blue. It's the 90 days delinquent plus the foreclosure inventory. And this is data from Black Knight as well as the forbearance data, as it just showed was. And there's 1.4 million seriously delinquent now. That has come down quite a bit. A year ago, it was at 2.6 million in August 2020, but we still have an excess of about 720,000 seriously delinquent loans. And the ones that are remaining seriously delinquent are in a deeper delinquency hole, average of over a year delinquent on the loans, a year worth of missed payments on those 90-day plus. If you look at just the foreclosure inventory, which most of those in the foreclosure are going to be properties that had started the foreclosure process before the pandemic. But those are 1,700 days delinquent, which is just almost mind-blowing. But you're dealing with a very unique kind of set of properties there because of the foreclosure moratorium is cut off, new foreclosures coming in. So if we look at these numbers and start to try to break down the numbers, we would estimate that about 40% of the 1.4 million are pre-pandemic SDQ, and therefore they're going to be at higher risk for starting the foreclosure process pretty soon, potentially, given that the expiration of the foreclosure moratorium. And then another number to look at is that 25%, the roll rate from seriously delinquent to completed foreclosure, which by completed foreclosure, we mean the foreclosure auction takes place and the property is either sold to a third party or goes REO. So we see in a calendar year, those foreclosures represent about 25% of the seriously delinquent loans at the beginning of the year. And so if that rate holds true, we'd expect about 300,000 completed foreclosures in the next 12 months. And so this number is a little different than the forbearance one, but I think it's actually, forbearance is not looking at everything there's definitely a huge crossover, but it's not looking at the full pie, the full pool of everything that's seriously delinquent. So this is a little bit more holistic number. And so we'll put that 300,000, if that actually holds true, is that, maybe that sounds like a big number. Is that a big number relative to what we've seen historically? So we'll look at that in a second, but I did want to spend just a little bit of time on equity and whether that is going to prevent. We talked about equity a second ago, and the working theory, and a lot of people I talk to, and it really makes sense, is that home equity is going to be the salvation for many homeowners who are in those high risk categories, and also who are still long-term unemployed, as we talked about a second ago. And those are the folks who are high risk. They exit forbearance. They're not protected by the foreclosure moratorium anymore. What happens to them? Well, equity will save them, because certainly if you have equity in your house, you should be able to sell. And while I think there's truth to that, some of this data from Black Knight does show that there's and probably a lot of you folks on the call know this more than most, that there's irrational behavior that occurs, I guess is the way I would explain this. But if we focus in on the right hand graph here, what that's showing is the roll rate from foreclosure start to what they call an involuntary liquidation, which is what we call a foreclosure sale or a short sale. It does include short sale or deed in lieu of foreclosure. And what you see is that broken down by equity bucket. And what stands out is the bottom line there, the lightest line, are homeowners who, at least at the time of the foreclosure start, had at least 40% equity, and this is based on combined loan to value, not just their loan that's in foreclosure. But they're still rolling. Now you have to, and I talked to the Black Knight guys about this specifically to make sure I got this right, but we really want to focus in on the years from about 2015 to 2018. The line goes down in more recent years, but that's partially because of the foreclosure moratorium and partially just because it takes a while for a property to proceed from foreclosure start to involuntary liquidation. But really, at the end of the day, what they're concluding out of this is that 30% of even those high equity homeowners are rolling from foreclosure start to involuntary liquidation. And so that does fly in the face a little bit of I think some of the conventional wisdom out there that home equity is going to save everybody. And of course, you do see a difference. Folks with less equity have a higher roll rate into foreclosure. And then I also took some of the data from our platform, and we're seeing a similar trend. I won't spend too much time on this because I think I've been spending a little too much time on the slides, but basically what this is showing, I think the easiest way to look at this is on the right-hand graph, the percentage of foreclosures that have been completed on the auction.com platform where the winning bid was higher than the total debt owed to the foreclosing lender. We call those surplus funds. And so we're at, as of the first 9 months of this year, we're at 43%. It has come down a little bit, but 43% of those foreclosure auctions are generating these surplus funds above what's owed. And so you would think at least there's a chance for those homes having equity. And so it's a surprise really to us that that number is so high. Even if we provide a cushion and say that that winning bid has to be at least 20% above the total debt owed, we still come up with 21% of the foreclosure auctions that are taking place have those surplus funds. And so I would certainly say it's safe to say that most of those folks at least have some equity in the home and the property is still getting foreclosed. I think it's definitely a bad news situation, I think, for those homeowners. The silver lining is that at least at the foreclosure auction, if there's any surplus funds that, after the junior lien holders are paid, any junior liens are paid, then those surplus funds do go back to the homeowner. And so there is a chance for the homeowner to have a last chance to walk away with something to show for their equity, even at the foreclosure sale. And then, so I just wanted to talk about the equity because I do think the narrative that equity is going to save everybody, unfortunately, is not true. There's behavior going on that doesn't always make sense. It's not always rational. But then just jumping back to kind of the big picture, we talked about the 300,000 potentially being generated from the level of seriously delinquent properties that we have right now. And how does that compare historically? Well, even if we put that into kind of our, we did a separate model, and we, aside from the seriously delinquent piece that I just talked about, and we came up with, based on looking at unemployment and equity as the main inputs, about 1.3 million completed foreclosures over the next 5 years. And that actually is not much above. In 2019, we saw nearly 250,000 completed foreclosures. And so we end up really at the end of the day over the next 5 years, just a little bit above what we would have seen if we had seen 2019 continue for the next 5 years. And then we end up at a place where we're well below, certainly well below. And I think this isn't a surprise to anybody anymore. We're not expecting to see the kind of wave of foreclosures that we saw during the worst of the great financial recession from 2008 to 2012, where there were 4.8 million during the worst 5 years. And over a 10-year span there were 7.5 million. So that's what we're expecting. Of course, I mean, certainly pushing out to 2025 is, we don't know what's going to happen, but this is our best estimate using our models of what we expect to see happen. Certainly getting back to really around 2017, 2016 levels at the worst of this. We are, and so I want to shift into kind of, okay, a lot of this is what we maybe see coming. Right now, I just want to shift for the last few slides into what is happening now, what is already happening. And are we starting to see some of this inventory emerge? And if we look at FHA data, and this is from the FHA Single Family Loan Performance Trends report that they put out monthly, we're starting to, and I look at FHA, it's not the biggest part of the market, but certainly we expect it to be an important part of the market because those are some of the highest risk loans that have been originated over the last few years. So we see foreclosures, some of the post-moratorium inventory starting to emerge. It's certainly not an overwhelming wave of distress, but we're seeing foreclosure starts up 44% in August from July, and for FHA up 164%. I mean, we're talking about small numbers here, so the percentages are a little bit tricky to make sure we put that into context. And the inventory is up 76% post-moratorium as well. So we're definitely seeing some increases in FHA. If we look at, there's great data, by the way, if you haven't accessed this, the FHA Neighborhood Watch portal, where you can go in and really look at dig into a lot of this data. But what I did is I looked at the FHA foreclosure inventory there in July, as of July 31st, 2021 versus September 30th, 2021. And we definitely see a significant increase. And this is, so properties that are actively in foreclosure that are on FHA loans, that increased by 33,000, which is this huge percentage, 215%, but coming off of a very low level. So I don't want that 15% to be the huge takeaway, but certainly we saw an increase post-moratorium in this foreclosure inventory. States with an increase of at least 1,000 were Florida, Illinois, Texas, Ohio, Indiana, California, Minnesota, Maryland, and Oklahoma. And where we didn't see as much of an increase is probably, at least was not a surprise to me, some of the states that tend to have extra protections in place, as well as states that have a judicial foreclosure process that tends to be slower. So places like Pennsylvania, New York, New Jersey, and North Carolina, you still see these fairly big percentage increases, but that was below the national average. If we focus in on auction.com data, here what we're seeing is, what this graph shows is the volume of foreclosures that we're handling relative to pre-pandemic levels. And so I really think of this, some people talked about the pandemic is going to produce this huge wave of foreclosures or tsunami like the last recession, but certainly we're not seeing that develop. This looks more like a slowly rising tide of foreclosure volume to me, which is probably the best scenario and really the outcome that that the folks, the policymakers and others who put into place the forbearance programs, the moratorium, were thinking. To me, this is the type of scenario that is optimal. Where we're seeing that gradually rising tide. We're at 32% as of the third quarter, 32% of pre-pandemic levels, which means, another way of saying it is, we're 68% below pre-pandemic levels, even in the third quarter when the moratorium for most of the quarter had expired. And now it is at its highest level during the pandemic, granted, but we're still well below those pre-pandemic levels. And then if we look by state where we're seeing in our data the inventory emerge, you can see there the green is where we're seeing it higher relative to pre-pandemic levels, and the blue is lower relative to pre-pandemic levels. So you see mostly in the Midwest and parts of the Rust Belt, where we're starting to see the volume emerge more quickly post-moratorium. This is as of the third quarter. Some of the higher volume states like Texas and Florida they're right at about the national average of about 30% of pre-pandemic levels. New York is well below that, and New Jersey, also some high volume states. California was a little bit of surprise. We saw a little bit above the national average of 34% of pre-pandemic levels, but still certainly well below those levels. But this gives you an idea of where that volume is starting to emerge. And these are actually in contrast to the FHA map that looks very similar to this that I showed a second ago. These are completed foreclosures. The FHA is foreclosure inventory, so that's more what's coming. This is what's happening right now in terms of completed foreclosure auctions as of in the third quarter. Oklahoma stands out. Oklahoma is a fairly high volume state. North Dakota is not. So the 133% level there is very low volume. Oklahoma is higher volume, and Indiana, those would be two states I would say they're high volume and very close to getting closer to pre-pandemic levels. And then another way of breaking down our data is by loan type. We're seeing there on the left-hand side, the size of the circle represents the percentage of total inventory. And so, FHA, GSE, Fannie and Freddie, and private portfolio, those three together are making up the majority of the volume. But then what you see there is FHA and private portfolio are the ones that are coming back. Those are the loans that we're seeing go to foreclosure auction at a little bit higher rate than the national average. And certainly if you look at the Fannie and Freddie loans, those are underperforming in a good way, below at only 28% of pre-pandemic levels. And so that's probably not too much of a surprise either. Certainly we, even going into this, we saw FHA as a higher risk type of loan. And then the private portfolio loans as well. Those would be the ones that would not be as subject to some of the protections. And so that may be some of what's happening there. And then we looked on the left-hand side or the right-hand side. Might be a little bit hard to discern this, but we're trying to look at value range. I mean, what value ranges of properties are going to foreclosure auction? And the one that stands out is early in the pandemic, we saw a spike in the percentage in the low value band range. And this value band is based on the credit bid set by, or it's not set by the servicer, but the credit bid at the foreclosure auction, which is the maximum amount, basically their reserve, maximum amount they can set as their reserve for the foreclosure auction. We saw that low value band jump up earlier in the pandemic to 33% in the third quarter of last year. And that is, I think, primarily a result of mostly vacant properties going to foreclosure auction. And so there's a higher percentage of those that are in the low value band. And then but that has come down, and it's now at its lowest level in the third quarter of this year that it has been during the pandemic, as we see the shift maybe away from some of those vacant properties toward other properties and higher value properties. And then also you have the fact that some of these properties are just the values have increased. And but we're still seeing, if you add these up and you look at we're still seeing almost half of the properties in the value range of under $100,000, and then a little over half that are above $100,000, with the biggest percentage being in that $100,000 to $200,000 range. I know that all of you are very interested in the occupancy status, and so it's a little tricky though. So I have to have a caveat here with the foreclosure auctions. When we get those coming in, we haven't historically had really robust data on us knowing if the property was for sure vacant or not, or the occupancy status. So we, in the past, to be safe and to protect the current occupants of the home, we have assumed it's occupied, it's presumed occupied. If we don't know for sure that it's vacant, if we don't get that data ironclad from the servicer. And so that's a caveat. We started collecting that more robustly, really starting in the second quarter of this year. And so the way I've couched this is just looking at the trend that we're seeing in the percentage that are vacant versus the percentage that are presumed occupied. And so you see in the second quarter, and we just didn't have a really great data prior to the second quarter of this year, but even in the second quarter, we were seeing increases in the percentage of that were known vacant. And that continued in the third quarter, in the third quarter. But now to date, obviously the fourth quarter is not over, but so far in the fourth quarter, we've actually seen that trend reverse, and we're seeing a decrease in the share that are vacant and an increase in the share that are presumed occupied. So that's a shift that I think is somewhat expected as the moratorium expired, but we are seeing that. A lot of servicers are still being very cautious and sticking with the vacant, but we are seeing a little bit of a shift toward the occupied or at least presumed occupied properties that are making it to the foreclosure auction. And then a shift so we've been talking about foreclosures, which is really where the action is happening right now, because that's where, as some of these protections lift, that's the first place where we'll start to see any emerging volume take place. But the REO, I do certainly want to talk to that, and that's what's happening in foreclosure right now is going to trickle down to REO in the next few months. But as opposed to foreclosure, where we're seeing that percentage of pre-pandemic levels start to increase and that rising tide, we're still seeing the tide going out on the REO. And we're in the third quarter, we're 14% of pre-pandemic levels in relation to pre-pandemic being the third quarter of 2019 as a benchmark. Now the interesting thing that it's a little bit opposite on the state level too with REO is the states with the most inventory are the ones that actually we don't see emerging on the foreclosure side, and that's Illinois, New York, Pennsylvania, New Jersey, and Florida. And what I believe is happening there is those actually, even leading into the pandemic, those tended to be the states, maybe with the exception of Florida, where we were still seeing inventory coming in from the last recession, the really long tail of that. And so those had the most inventory left over that was still being worked through. And so those are the states that still have the most REO volume. And a lot of it is very aged inventory from, as I mentioned, from even the last recession and after that. Some of the states there with the biggest increases in the third quarter, we did see some states with increases: Michigan, Kentucky, North Carolina, Connecticut, Georgia, and Alabama. So it had some increase. Again, those are coming off of low level, but we are seeing some more inventory emerge in those areas. And then occupancy status on the REOs is a little bit more solid and clear. And we're seeing in the third quarter, it's roughly half and half, 48% were vacant. And that is up from the previous quarter, but down from a year ago. And so far we've, the overall, despite that kind of last quarter trend, the longer term trend in 2021 has been a little bit more toward a lower percentage of vacant properties, an average of 41% compared to 53% that were vacant in the first 3 quarters of 2020. And this may have to do with the eviction moratorium expiring and there being some more willingness to go ahead and sell some of these occupied properties that are bank owned. And I talked there about some of the states with the most vacant REO volume and the above average share of vacant volume. there being California, Florida, Georgia, Iowa, Idaho, and Illinois, where we're seeing well above 50% of the volume in those states that are vacant REO. And this is these are properties that were brought to auction on our platform, just to be clear on that, what I'm talking about when I'm talking about REO inventory in the third quarter. And then one last shift I want to talk about before wrapping it up, and then answering, hopefully have some time for questions, we'll see, is just what we're seeing. We're looking a lot more at what's happening after a property transaction on our platform, after it's liquidated, what happens. And there is a lot of encouraging data. There's, I think, opportunities to improve. A lot of buyers, like those that are on the call, are doing great things for the communities that they're buying in. And one thing that we're seeing is when we look at occupancy rate, and we do that by looking at assessor data and looking at the county assessor's occupancy status of a property after it's resold. So it's sold on our platform at foreclosure sale, and then we look at the owner occupancy status. So we certainly see when a property sells to a buyer at our foreclosure sales, it's around 70% of those, once they renovate and resell those, are going to owner occupants. And that is pretty consistent. Both we overlaid low income tracts and minority tracts with the help of the folks at NCST to pull in some of that data. And we found that was pretty consistent even in the low income tracts and minority tracts. When the gray bars there are when a property goes to REO and it sells, the bank then sells it themselves, we're seeing a much lower rate of owner occupancy, which we believe, that's what's happening there, is that these properties still have to have an intermediary of an investor or developer coming in to improve the property before it goes to an owner occupant. So when it sells as an REO, it's still, many of those are still going to that investor or developer buyer before. And what we haven't done is looked at the sale after that to see if they're eventually ending up as owner occupied, but at least in that first sale, they're not. And so, there's implications of that. And then I think there's a lot of good news here. The one thing, and this is something NCST helped kind of suss out of the data, is that the one area that we noticed of opportunity, or where we're falling short in all of this, is if you look at this by value bucket, which I don't have on the graph, but we do see a weakness there. If you look at properties that are valued below $35,000 or selling at the foreclosure auction below $35,000, when those resell, the owner occupancy rate is only 41% versus that 70% across all value bands. And so that's an area, I think, that just needs some more consideration and thought about what's going on there, and if there's any way to improve that. Another thing we look at is the value gain of the property after, and this is, we don't know how much is spent on renovations once a property is purchased on our platform, but this helps us get at that. And what we're seeing on the left-hand side is after a properties, and this is from the time range here, is we looked at sales between 2019 and 2020, I believe is the time frame, that were sold on our platform. They sold an average of 160,000. When they were resold, 70% of them going to owner occupants, they were sold average price of $250,000. It's a big rise in value. We look at it relative to the after 2021 after repair value. It's a 34% rise in value relative to that after repair value. And so, and the average time, I don't think I have it on this graph, but the average time is around 250 days between these two sales. And so that indicates to us at least that there is significant renovation going on between those two sales. and many of the buyers are adding value to these properties through renovations before they resell them. And then as a kind of foil to that, again, looking at properties that didn't sell to buyers at the foreclosure sale and went to REO, and then the bank sold them on the MLS as an REO sale. Those actually, now it's a little different here. The value here is not the price at the foreclosure sale because there is no price. It's the value that the estimated value that the seller or the servicer thought the property was worth at the foreclosure sale. And then what they actually ended up selling for was on the MLS was less than what they had valued it for at the foreclosure sale. And, I believe that's just another sign that, again, a lot of these properties are being, even if they go REO and are being sold on the traditional market, maybe with the goal of selling them directly to owner occupants, they're still going to investors. I think this is another indication of that. And then the last thing I have is just looking at the affordability piece. That $250,000 we talked about of those resales. If we look at the census tract data and look at the median income in the census tracts, on average, those sale prices that make up that average 250,000 are 3.4 times or price to income ratio times the median income in the census tract where the property is located. So if we compare that to the retail market, that's 4.4 price to income ratio. If you look at across all existing home sales, not just distressed sales, we do see a higher price to income ratio in low income and minority tracts, but certainly actually see lower price points there as well. So I think there is some hope that these distressed sales that are happening are producing some affordable inventory out there in the marketplace. And all right, so that's been a lot that I've gone through just now. I think we have a few questions coming in, and I'll stop sharing. Actually, maybe I'll keep sharing for a second just in case we need to go back and reference some of these slides. But David, do we have time for questions, or we need to move on?
Yeah, absolutely. So, I think we're a little constrained for time, and we recognize that a lot of people are going to have to leave at 1:30. I think if you can stay on a couple minutes past 1:30, at least on East Coast time, we'd be interested in going maybe a couple minutes over for those who are able to stay. Our first questions that came from Kevin Moody, and he was asking about, auction.com and NCST partnerships and pilots. I think many of our buyers know that we did a pilot program together last year to kind of list some auction.com properties to NCST buyers. I'd say I don't want to get too far out ahead of ourselves. I don't think the plan is to renew that pilot under the structure that it was operated in last year. There are a couple ways that those sales were different than the way that our normal first look sales work. There wasn't an exclusive purchase opportunity, for example. I do think we are interested in thinking about other ways that we could work together as organizations. I'll put a pin in it, but I do think, and hopefully I'm not surprising Daren here, one interesting place could be on FHFA CWCOT second chance sales, where we do think that FHA is going to move towards having kind of a nonprofit first look within those sales. I don't know if there's anything you want to add there, Daren. If not, I can turn to some of the other questions.
No, I think that's a great answer. And I mean, that's a great answer. I'll leave it there.
Great. Lovely. Well, I think we had two clarifying questions come in. One was from Catherine Peoples about the appreciation being 24% or 34% on average. I think that might have been on one of the slides right before this one.
Okay.
But I'm not actually certain exactly what slide. Oh, yeah. I think it was the first point on this slide, probably the first bullet point, about 34 points in value added between the third-party sale and the resale of the renovated foreclosure. Does that seem correct to you, Daren?
Yeah, so what that's talking about is just that it's a 63% versus the 97% relative to the after repair value. That's the 34 points, percentage points in value increase, as opposed to percentage increase in value, if that makes sense. So I think yeah, if you look at the actual dollar figures, that's more like 24 to maybe 26% increase in value. But I use I tried to have a benchmark relative to the after repair value, so that we're actually taking out the element of appreciation that's occurring in the marketplace by itself. So
great. You know, and then the last question from the audience that we're seeing right now is Michael Roberts was wondering whether you know anything about kind of unemployment rates by age group. You know, going back to the beginning of your presentation.
Yeah, that's a good question, and I can't quote those off. That data is available out there, and I think it's be interesting to look at. I don't know it off the top of my head, so sorry, I can't answer that. But certainly that data is available if you go to the BLS, or a great source of that data would be to go to the St. Louis Federal Reserve site. They have great data that you could break down that way.
Excellent. I think I might see one more Q&A from Dave Picorni about talk of raising the AMI due to the increase of housing pricing. You know, I admit, I don't know that that's something that we've thought about a lot at NCST, Dave, but we'll certainly, you know, let you know, and we'll take it under consideration. With that in mind, I know we went a couple minutes over.
Can I ask Daren some questions?
Yeah,
before
absolutely. Let's do
go?
that. Julia's gonna pop us, finish us off with a quick policy update and a couple questions for Daren.
Yeah, before we let you go, I am curious. You know, I found your slide about home equity and foreclosures especially interesting. That's you know, I've spent the last couple of years explaining to everybody that just because you have equity doesn't mean you're not going to have a foreclosure. But I am curious, and this is one of the things people have been asking me about, is whether the rise of iBuyers and other very easy ways of disposing of your home will have an impact on that. And I was just wondering what you thought on that.
Yeah, I think that's a good question, and I would think it would have some impact on there. I don't have any data to support that, but my thought is, as there's easier ways for homeowners to sell, that could certainly be the case. I mean, I think one thing that we've launched is a pre-foreclosure sale program. We haven't seen a lot of volume there yet, but basically lenders coming to us and saying, this homeowner is delinquent, they really need to sell, but and in most cases they think it needs to be a short sale, but what we found is when we put it on our platform, it ends up being, not all of them, but we've had quite a few that have ended up being equity sales. The property is put on the MLS, it gets X amount, it's put on our platform, and sometimes the MLS offer is higher, sometimes it's higher on our platform, but it's about half and half. We see it sometimes go to an equity sale. So I think, to wrap around to your actual question, is there are opportunities to think innovatively to help homeowners who maybe even don't realize or think they have equity to sell and avoid foreclosure, as well as realize equity that they may not know they have.
Right, and then there's a third option there, which maybe isn't so much your job, although it's interesting to think about in what way the auction sites could participate in this, which is when someone goes to sell in a for sale situation, even if it's not actually going to end up being short, whether they've taken advantage of loss mitigation opportunities from their servicers. Because I suspect a lot of the same people who are coming and thinking they're in a short sale situation and they're not, may also not have fully run down the possibilities for staying in their house through a loss mitigation solution.
Yeah, that's good point there. Yeah.
Any other of our staff have a burning question before I go on to the policy update? Well, I'll just end by thanking Daren so much. You have been, you have always, from your time at Adam to now being at ADC, you have always been extremely generous sharing your insight and knowledge with NCST. We greatly appreciate it. This was a fantastic presentation. I'm sure many people will be looking at it after the fact on our website. And I'm sure we'll make your appearances on here a regular thing if you're willing to come.
Yeah, I'm happy to, and I'll give you more time next time, Julie.
All right, well, let us move now to the policy update. I'm going to be absolutely short and sweet because I can tell you where to find other information. But the biggest thing happening right now in Washington is, of course, on the legislative side, as Congress continues to consider the Build Back Better Act, which, as people know, is also known as the Reconciliation Bill, because it would be a bill that would proceed with the need for 50 rather than 60 votes. The current status of the bill is it is being finalized in the House, and we expect maybe even before Thanksgiving, hopefully before Thanksgiving, to have a vote in the House. We then expect that the bill will move to the Senate, where consideration is likely to take most of December. The Senate will have a number of other things to deal with after Thanksgiving, which is, of course, raising the debt limit and dealing with some of the spending bills for next year. Those might get punted over into 2022 with a continuing resolution. But it does seem like if we don't see the Build Back Better Act pass in 2021, I'd say most odds makers are going to start, having significant concerns about whether it will pass at all. As everybody here, I hope, knows, passage of this bill would be of enormous, almost unbelievable advantage to distressed communities. And just even in the housing area and the home ownership area, for what a lot of us do, in addition to the demand side support, $10 billion for first generation home buyer down payment assistance, $5 billion to subsidize shorter term mortgages to enable first generation home buyers to build equity more quickly. There is also a ton of money that would come in for those of you who do development in this area. Perhaps most notably, the creation of the Community Restoration and Revitalization Fund, which would provide HUD with $3 billion to fund competitive grants in distressed communities to create affordable housing that includes both rental and home ownership. The CDFI fund's new housing investment fund, also eligible for home ownership up to 120% of AMI, to a question that we heard earlier. Another $10 billion to the home program, a small dollar FHA mortgage program, and of course, the thing you've heard from us most frequently, establishing the Neighborhood Homes Investment Act, which would create a new federal tax credit that would cover the gap between development costs and sales prices for homes that are sold to owner occupants. So there's a lot on the line with this bill. You should know that if you have not yet been in touch with your representatives in Washington, they still very much need to hear from you if this bill is something you support and want to see happen. Extremely important that we continue to have support from from the country coming in for the home ownership provisions, because those could drop out if we start getting in a situation, of significant editing in this bill, which, it is highly likely to happen, frankly. A couple of other policy issues I just want to touch on. Daren mentioned that FHA issued its annual actuarial report that came out, I believe it was Monday. And I highly recommend everybody read through that if you want to know what's happening with FHA, and particularly if you want to know what's happening with loss mitigation and with which properties you might ultimately see coming through that foreclosure pipeline. Few other things happening. FHFA is receiving comments on changes to the capital rule that was promulgated last year. These would be changes that we hope would be directionally positive in terms of GSE activity to help first-time home buyers of color, and low-income home buyers. So I'm going to stop there because it's 1:40. I'm also happy to stay on a little bit longer and take questions because I see there's a lot of you still on the phone. Again, thanks to everyone for being here.
Wonderful. Thank you so much, Julia. Just quickly, so that everyone does see this, we will be putting both the recording of this call and the slides from Daren on our website within the next several days. If anyone does have questions for Julia, we're happy to answer those. Otherwise, we will see you on Wednesday, December 15th for our last call of 2021. We'll be joined by our policy team here at NCST to talk in even more detail about those upcoming bills. Marcia, we will also go ahead and put the link to the FHA actuarial report on our website. So please look for that there. With that, thank you so much for staying on today. We're thrilled with all of those of you that joined, and great information. Thank you again to Daren Blomquist from auction.com for a fantastic presentation, and we look forward to talking with you next month.
Bye, everyone.